Okay, good morning to all of you, those who are here as well as those who are online. The session today will be a discussion on a continuation of the discussion on CVP analysis, and depending on how much to what extent we can cover today, we may start the next section that is about overhead related accounting and product costing. Right? So just to spend a very little while, short while in thinking about discussing what we discussed last time. So basically, we wanted to understand this idea of CVP analysis and what is CVP analysis, right? And then what types of business decision-making situations we can possibly use the CVP analysis to facilitate more efficient and effective decision making. And this exercise, we took a very simple example, but the whole exercise actually we finally looked at three different equations, three sets of equations, and you would have seen these equations were twofold. One set of equations always had contribution per unit in the equation, and always it was talking about the number of units. The other set of equations we had the contribution to sales ratios, and outcomes we were discussing in terms of revenues, dollars. So when we work with the units, we work with one equation. When we work with revenues, we work with the other equations. That is what we did. And if I very quickly, if I put these three equations, right? The first set was like break-even point in units. We say fixed cost divided by contribution per unit, right? And then we also said volume for a desired level of profit would be fixed cost plus that required level of profit divided by contribution per unit. Or else we also have to look at third one is volume multiplied by the contribution per unit. So this is our total contribution minus the fixed cost is our profit, right? So this is one set of equation. Like I told you, all the parameters are here. We use the contribution per unit, and the answer is always we were getting volumes, right? And then the second set of equation, break-even revenue fixed cost divided by the CS ratio, revenue for a desired profit CS ratio, and here okay, right? So now you see these are similar equation, and here in units and here in volume. So basically, and then also when you say total contribution, we can calculate in three different ways: either total revenue minus the total variable cost, or else here volume into the contribution per unit of the total contribution, and revenue into CS ratio is also the contribution total contribution. So these are the equations that we looked at. And also we did another exercise at the end of towards the end of the session, where we did a sensitivity analysis. Right? In the sensitivity analysis, what we actually did was we had the, say for example, we had selling price less variable cost is the contribution, say probably to multiplied by the units, you may get the total contribution, and then less fixed cost is your profit. So we had an equation like this where we check by changing each variable. If you want to have a desired income, you change the selling price at one point of time. By how much you should change the selling price to achieve the desired level, or by how much should you change the variable cost to achieve the desired outcome, or by how much you should change the fixed cost to achieve the desired level of outcome. So how you keep changing this. So this sort of analysis, we call it the sensitivity analysis, is important. In a simple decision making situation, you are trying to launch a product, some promotional campaign, and make a quick decision. So you trying to meddle with the variable. If I offer at this price, what would be the demand, right? And then can we get the profit, or can I cut down on my other costs? Build the staff. So like that, you always manage these variables and try to see what combination of variable would give you the desired result. Okay, so therefore this is a simple handy tool that can be used. Like I told you, it can be done on Excel very easily. If I bring my computer today, probably I'll try to show you how you do it with a simple thing. So this is basically where we stopped our discussion, right? So today we are going to extend this discussion to capture two other aspects. One is that, okay, if you look at these two sets of equations, now I showed you that if you do the computations based on this equation, right, you can get to this equation by multiplying by selling price. So if you do this equation, you get any answer, but you can go to this. But then, what is the purpose of having these two sets of equations? Okay, what is the purpose of having two sets of equations? So that is, what do you think? Actually, the reason for having two sets of equations is there are certain types of business decision making situations where we can't work with this equation. Simple example, I asked you that question earlier, right? In your type of organizations, how many different products that you have? A typical organization. Do you think of, can you tell me an organization which just sells one single product, one selling price, one variable cost per unit, and like that? Any business organization, any company that has a product like that? You hardly have, right? You would hardly have organizations like that, because you have multiple products. You have multiple products selling to multiple customers. So it's a wide variety of products you have in at least a couple of variants you'll be having in any manufacturing or service organization, right? Most of the instances, like I told you, very standard taxi service or a tricycle service, you are charged by the number of kilometers. Probably that can be the situation. Or you have some consultancy business, every hour you charge by the hour. The same type of pool of consultants or outsourcing company, you have pool of people, and then you hire them on a particular rate, and no differentiation, distinction, but that like that, right? Manpower company or something like that, but then again depending on the skill level it could vary, right? So therefore there are no situations like that. So now, okay, what is the extreme where we have so many hundreds of different products? Can you tell me an organization which has so many hundreds of different products? Unilever. Okay, so you have so many different products. It can even be more complicated, like many Unilever, famous, and all of them put together, you may have what? Link, all that put together, you may have in a supermarket, right? So you may have having thousands of different SKUs. Right? So now let us say you are involved with the market operation and you want to look at the break-even point. How do you do that? What is the contribution per unit you are going to use for all your computations? Any idea? There is no single product, but if there are, I am not going to discuss that here in this class, but if there is a handful of products, so you can use a weighted average, right? Weighted average contribution per unit. But then again, if it is 3, 4, 5 different products, you can probably do it. But otherwise, it's not possible. Right? So it is not possible to do it this way. But now, say someone who is running a supermarket, into supermarket business may know you may have different product categories. Right? Different product categories. What are the different product categories that you may have? Grocery items, right? And then meat products, and then vegetables, right? Or cosmetics and personal care items, and then stationery, pharmaceutical items, and like that you may be having wide range. So you may be having thousands and thousands of different products, but all these different products may be put into a couple of main key categories, like they classify under key categories. Like I told you, maybe 5 different categories, may not be maybe 10 different categories, right? So it is impossible to do an analysis using the contribution per unit. Not only the product, it has to go to the each SKU level, like each pack size, bottle size, all that it has to go to. It's not possible, but each product category, so there is a certain level of margin that you will be having, right? You know that, okay, any business, so you may have different segments of the market, right? It is not 100% accurate, but you know this particular segment, this is my pricing level, this is my margin. Another product category, this is my margin. For this customer segment, this channel, this is my margin. So like that, that information you have. So therefore, what you are going to do is now, it is like it's not a 100%, but very much enough, very much accurate, very good enough for good analysis, serious analysis. What we do is we try to identify them into different categories, right? We try to identify them into different categories, right? So tell me, can you tell me what are the categories? We can't. The principle is the same. So, but so therefore we let's speak about 3 different categories of products, right? To make it easier, right? What are the different product categories you want to pick for a supermarket? What are the product categories that you want to look at?
Fresh produce.
Sorry?
Fresh produce. Fresh produce.
Okay, fresh product. Okay. I don't know how exactly you can calculate, but they classify, okay, fresh products, vegetables and the fruits and all that. What else? Yes. Okay, let's say meat items. This is the vegetables and the fruits and the meat items. What else? Grocery items.